All right, it's been long overdue as I have not talked to my friend Brett Manning in probably almost a week now. And since we had some crude oil data and now this newest round of news about the tariffs, it's a good time as any to bring in Brett Manning, chart trader. How you doing, sir?
Doing pretty good, Jim. How you doing?
I'm doing well. So, I think we'll touch on crude oil first because that's the freshest set of data. Have you had enough time to process it and get your take on the number that we had?
I don't know if there is enough possible time to process that number.
It was weird, right?
It's weird. And, I suppose that it's just people are underestimating the impact of the Syncrude outage. I think that's got to be pretty much what's happening here. But, the market is just digesting it. Now, to be fair, we have rallied quite a bit on this. I think that basically the move that we saw from 65 to 75 is pretty much, it's part of a longer standing bull market in crude oil, no question about it. But it is also pretty much it covers the period of when we really started to have market consciousness of the outage in Syncrude, and that it was going to be something that lasted a month or two rather than a day or two, and that has a huge impact on inventory levels in the U.S. So we continue to see this big impact on the first couple of months looking out in the U.S. And not that much of an impact when you start to get into the October, November, December contracts. Really, they haven't moved a whole lot in the last few weeks, but the front two have just taken off. And I think that, again, that kind of signals what the issue is. Now the question is, if the estimates didn't remotely understand how much of an issue we were starting to see in terms of a supply shock at Cushing, then, why did the market? And that's kind of what it almost looks like here, is that the market has been pricing this in, but yet the estimates weren't even close. So you can either look at this as the market is out of sync with the estimates, the market knew, the estimates didn't, they don't constitute the same predictive body. Or you can look at it as, there's one other theory, which would be that the market is starting to sense the possibility that as the supply shortage, due to short-term, special, one-off type of factors, as that supply shortage becomes more intense, that there's a greater likelihood of some form of something we might consider an intervention, whether it has to do with the Strategic Petroleum Reserve or more pressure on Saudis and Russia to pick up the pace, or something else. And a lot of times you get that sort of dynamic in markets where when something happens that's extreme enough, it triggers an expectation of some kind of stabilizing reaction from the system. So if you get, if this build was a little less big, the market might be taking off to the upside. Or if this draw was a little less big, the market might be taking off to the upside. But as big as it is, as clear as it is how fast supplies, inventories are being drawn down here in the U.S. for oil, maybe that's, and this is just a theory, but maybe the reason why the market isn't reacting and ripping to the upside is some combination between having priced things in and that this is dramatic enough that the market is starting to suspect some kind of extra force, some externality to come into play. So I'm really not sure. It's a pretty striking number, and it's striking to see the market chop sideways.
It is a striking number, but what may not be striking to a lot of people is how off the estimates seem to be all the time. I'll tell you, that's got to be the easiest job in the world. Because you're not held accountable to anything, apparently, because they are always off, and off by a large margin.
It's gotten a lot worse, too. Lately it's been a lot worse.
Yeah, for sure it has.
Yeah. And I wonder if people are starting to, I wonder if that impacts things. If you have a series like we've seen over the last couple of months where the estimates have just been, not even remotely in the same county as the data, I wonder if that just kind of, I would assume that over time that just downgrades the importance of the estimates and the market just becomes more volatile in the days leading into the number because it does not, it doesn't have anything that you can rely on to price in.
Well, at least they were on the right side this time. At least they expected a draw. half the time it's usually they're expecting some type of
They're
build.
probably high-fiving somewhere in an office in Washington.
That they were on the right side, exactly. All right,
Yeah.
so safe to say you don't really have a good trade idea as of yet for crude oil, right?
So, I want to talk about a couple things. One,
Okay.
if you pan back, so you can look at this Syncrude situation and the data we're seeing right now, but it's good to say, okay, that's rooted in a context. And the context is, broadly speaking, that we have flipped from being an oversupplied market to an undersupplied market, not just in terms of inventory data, but in terms of the way the world works. We've got issues with getting enough employees and parts and pipelines and everything else to be able to supply enough crude. Now there are bottlenecks in supplying necessary resources. That's been a story for about the last 6 to 8 months. Now we are seeing maybe some speculation that Saudi Arabia really can't step up the production quite to the level they boast they can, because of course they want the market to believe that they're essentially like the Fed relative to oil prices. So the Fed relative to short-term interest rates, they are relative to oil prices. That's a position of strength. That's a brand, and they want to maintain that brand, and so they need to be able to purport to be able to do whatever necessary on either side. That's a tremendous situation to be in. But there's some sense that maybe there's some predictions that they really can't do that if they had to, and of course we see Venezuela supply going off a cliff. We see political pressure to knock Iran off the map, and there's a whole context here that leads to the later stages of a bull market move in oil that has more to do with these than these immediate little impacts. We've also got just the effects of the tax reform in the United States with sub 4% unemployment is a strain on supplying oil. You start to throw leaves on the fire of the cycle when the cycle's at that point. You can really create a scramble in terms of demand. So there's all of these different factors that go into defining the context that oil is trading in right now. And the question is, do we come up with counter-cyclical approaches? Do we come up with ways to generate new supply? Because you overshoot at both ends of the spectrum. Another big picture point to make. When we were down at 26, we were looking to buy oil, and we wanted to align ourselves generally long the oil market, because you could find ways to look at that situation that suggests that there would be an infinitely growing glut that would go on forever into the future. But that's not the way a commodity market works. That's a great market for people to start to shut down forms of supply, for people who have investment capital to stop investing in extra capacity for oil. And so that's what happened in late 2014, 2015, 2016. We went through a process of just, completely cutting off the hose from money to oil capacity development. And so we overshot, right? And so now we're dealing with the consequences of overshooting in that direction as we suddenly have these bottlenecks in terms of getting enough capacity going. And we see problems like we see in Venezuela and et cetera, et cetera. That's the cyclicality of a commodity market. And the other side of that coin, when we were at 26, I don't know where it's going to be, maybe 80, 85, or 90. The other side of that coin is we're going to overshoot developing new capacity. There's just no way around that process. And it's going to come in the form of some kind of putting in measures to stimulate advantages for people to develop more capacity for oil, because that's a good thing right now. It obviously isn't going to cause a problem in terms of knocking the price too far down or creating a new glut. At this point, I think we're past that danger, so we probably start to overshoot at the other end of the spectrum, and it's just a matter of when that kind of process catches up with things. So, you want to watch for that. But in the meantime, there's a point that I made yesterday, and I got a couple of emails on it, and I wanted to just make sure that I took the opportunity to explain it a little more. And I don't know if you saw it. Did you see the post that I did on backwardation and oil ETFs yesterday?
Oh, no, not yesterday. I remember one that you did last week, but no, I didn't look at yesterday. I can scroll back, though, and read it. You want me to post it for everyone?
I can just, I'll just appraise you of it.
Okay.
So I posted something that basically, it's a point that I made actually maybe like a month ago, or maybe a little bit more, which basically says, so when we started to see backwardation in oil was a couple months ago, right? And it's the first time that we had seen backwardation. Backwardation being any futures market has and I know you know this, I'm just explaining for the listeners, any futures market has a series of contracts with successive monthly expirations or quarterly expirations, depending on the market. So for something like crude oil, the front month contract is trading now, be August, then it moves to September, then it moves to October, then November, then December. But at this moment, all of those contracts are trading. They're just, M2, M3, M4, month 2, month 3, month 4, looking out on a curve. So they all have current prices. There is a price for October crude right now. There is a price for November crude right now. So backwardation is just when you see the prices as you go forward on the curve, as you go out to successive contracts, the prices are successively lower. So a downward sloped forward curve. Contango is the opposite. That's an upward sloped forward curve where the prices are successively higher. So in a demand situation, in a undersupplied situation, you typically see backwardation. It's one of the ways to identify a thoroughgoing bull market in crude oil. When you have a bearish context or an early stage recovery, you typically see contango. And a simple way to think about this is it's like the market trying to be smart about dealing out oil. This isn't actually the cause of it, but it's a good heuristic to understand why it would be one way rather than the other. Obviously, if you don't have enough oil lying around, you're going to incentivize people. You say, I'll give you a discount if you wait till next month to buy it. All right, so you need a lot of oil, sir? I'll tell you what. If you wait a month, I'll give you a 10% discount. So that's kind of a way to think about what the market is doing. When you have a glut, when I've got too much oil laying around, if I'm the market, boy, I've got too much oil laying around. Does anybody want some oil? I'll give you a discount if you take it right now off my hands. But if you wait a month, I'm going to charge you more for it. So the market can be seen as doing a clever process of pricing to incentivize balancing the market. So when you get into a situation like this, you can see the steep backwardation. It suggests that this is a real deal portion of a bull market. The market is trying to give people discounts for waiting for oil because it doesn't have enough oil lying around. So it's charging you more if you need oil right now. So when you end up with, I posted over the years countless times, I posted, repeated admonitions against people buying and holding commodity ETFs in commodities markets that are in a contango situation. Because an ETF, a commodity ETF, that holds futures is really just a futures trader that keeps rolling its exposure. So you can just imagine if you were to buy the crude oil front month contract, and when it gets close to expirations, because you don't want to actually take a barrel of oil and put it in your living room, you sell that contract and you buy the next one when it gets close to expirations rather than taking delivery. So you sequence these together to hold oil for a year, let's say. Every month, toward the end of the month, you sell your current contract, you buy the next one. If you're in a situation where the market is in contango, so each contract is priced slightly more expensive than the contract you're holding, then you're doing effectively, you're selling low and buying high over and over and over again. And this causes roll losses. So an ETF for a futures, for a commodity market where the ETF holds futures in successive contracts like this, in a contango situation, it's going to take serious roll losses. And what that means is, a good example is when you look at USO, before about 6 months ago, and compare it with the crude oil continuous contract over several years, you'd see USO during periods when crude oil is launching higher, you'll see USO going basically sideways and maybe up a small amount. You'll see crude oil up 200% over a period of time and USO up about 35%. And you miss all of those gains, and that's because it's losing 2, 3, 4, 5% every month when it rolls its exposure. So that's the problem for these things during a contango market. However, it's the exact opposite situation when you have backwardation. So the point I made yesterday is because Syncrude the outage at Syncrude has really been a near-term U.S. issue. What that means is it's really spreading out the contracts during the front few months in the U.S. That is exactly where the roll losses or gains happen for something like USO. So there's a huge buffer right now because of the backwardation. USO is going to be something like an expert trader for the next 2 months, right? It's going to do a perfect job, and these things rotate that exposure basically every day. They don't just get to one day, a couple days before expirations and sell all of one contract and buy all the other. Every day they're gradually starting to roll. They intensify as it gets through the month, but it's a very gradual, metered out process. So they're constantly going to be buying low and selling high. USO right now is buying low and selling high when it is rolling that exposure. Because it's a backwardation-driven market, it's picking up roll gains. So it's going to be outperforming the spot price of crude or the continuous contract for crude for at least while the Syncrude outage is in place, which is now believed to be well into August. So you're going to have an advantage with something like a USO or UWT, and I believe Mike just took a chunk of that. That is it's doing the same thing, it's just leveraging it up. Now the leveraging factor gives it a little bit of a decay, which works back against that a bit. So leveraging up your own money in USO, which you may be able to do, might be a slightly more effective route, but either way, holding that as a swing position, you're taking advantage of the backwardation and actually locking in a mechanical gain in the same way we used to take mechanical losses or point to people taking mechanical losses in an ETF like this during a contango stage for the market. So it's just it seems complicated. It's not really that complicated. It just means there's a mechanical advantage right now to those ETFs because we've really stretched those contracts out, M1, M2, M3. You've got something like, the way I calculated it yesterday, you got about 5.5% as a mechanical advantage in something like USO over that period. That does not mean USO will go up. It just means oil probably needs to go down by more than 5.5% over the next 60 days for you to lose money on that idea. So that's just a phenomenon that's and we're in backwardation. That phenomenon will stick around, but this is a particularly intense point in that because of the Syncrude outage and how it affects particularly US WTI M1 through M3 on the forward curve. So hopefully that makes sense.
Do you get involved in any type of arbitrage where you could take advantage of that?
If I wanted to take advantage of that right now, I would be long USO, and I'm not currently long USO. However, it doesn't mean that everything I just said isn't true.
Okay.
I know myself as a trader. Right? Some people are built to take trades like that, and I'm not one of them.
Okay. As far as any near-term, I hate to call them levels, any near-term ideas in crude, what are you looking to potentially, is there a shakeout level down to maybe 70 that you might be enticed to get back long? Is there something brewing in the mind of Brett Manning?
I mean, it depends on what it does. Like right now, see, this is from the typical way that I view markets. Right now, today, over the last hour, this is an awful signal. Right? I mean, you couldn't have a better piece of inventory data for the market from the bull side. And what are we doing? We are grinding lower, right? And now, obviously, there's deeper levels of analysis that may imply. If I'm able to understand why and sufficiently, and that's not the case right now, then it may turn into something where I'm looking for a level to buy. I would be thinking same level we looked at last time. A few days ago, we noted 72 to 72.50 off of that 75 challenge would be the pullback point where you'd start to see, kind of that Elliott Wave 4 lateral range trade kind of set in, and that worked out pretty well. Popped back up to 74.50 or so. But just seeing this mode, I mean, seeing the market sell this data is, if I was just sitting here in a long, on a swing basis, I'd have a hard time not just bailing right now because it's not how I want to see a market behave. I want to see a market do exactly the opposite of this. I would be buying crude oil right now if everything lined up, and everything lining up in this case would be terrible inventory data, huge build, market trying to go down and somehow starts to grind back higher. That would be a clear long, right? That would be an obvious long setup to me. You'd be with the larger trend, but you'd also be seeing that modal insight from the tape that not even bad inventory data can knock this thing down. And that means everybody who needs to be long if it goes up and who isn't yet long, namely commercial hedgers, are going to have to pour into that market and buy. There's no way they can wait any longer because, the horse is leaving the barn when it's not supposed to be, and that just forces activity. And this is the exact opposite signal. It's against the long-term trend. It's against some of the dynamics I talked about earlier, so I'm not shorting it. But if this same mode was happening with those dynamics in place, I would be loving to buy this. But this is just it's not right. Now, as I said, this may be implying some deeper levels of analysis, namely that we may start to get a sense that the problem in terms of U.S. inventory levels is something where if you extrapolate, especially on a second derivative basis due to Syncrude, if the Syncrude, let's say that we get an announcement this is going to be delayed until late September, then at some point there are levers to pull from the federal government or our trade partners or whatever. There are levers to pull to rip supply back into the U.S. market. And maybe this market is starting to see around that corner, which is why it's selling a data point like this. I don't know that that's the case. It's the only theory that I really have here. Because generally saying, well, this was priced in, it's a little tough to swallow because, presumably the estimates that we had out there were priced in, and this is 3 times that level of draw, and it's the second time in 3 weeks that we've seen that. So it's a little tough for me to just see it as, well, the market's up, whatever it is, 15% or something in the last few weeks, and therefore that's why it's not ripping on data like this. I think that you'd need something else to put into that equation, and I don't have it right now. So all I know is it's not acting like it should in what I recognize to be a typical bull setup.
Hey, Brett, it's Gavin here. You mind if I jump in for a quick question?
I would love it.
I love the analysis as per usual and stuff. One thing that I was looking at for weighing in on oil, and I could kind of follow the headlines a little bit, and therefore I'm just curious if you think that this headline could potentially be a headwind, and therefore your thesis is right, and even possibly giving you a potential better entry level on the long side. But do you think that Trump's meeting with Putin coming up is having any sort of negative sentiment on oil, given all the numbers that you've talked about, yet the direction that we're seeing oil trade here?
So, go ahead, give me a prediction of the headline that would come from that meeting that would play into what you're saying.
That Putin and we'll talk with OPEC about increasing oil production. We've seen a lot about Trump reaching out to Putin and Saudi Arabia for increasing production, and that's my thought process there in terms of President Trump going over there and meeting with Putin, and we see a headline similar to that, and that's kind of why I was looking for a little bit of a headwind on oil. And given the data, certainly there's that 15% run-up that you just noted that is a little bit of selling news, and then I suppose you could also look at the weakness in copper, which I know you talked about in your morning note, and that fear of a global slowdown in the economies given some of the trade wars. So that could certainly all be playing into sentiment here too. I was just curious as to how you're viewing that Putin meeting, and could that be a mask for what the proper move is that we're seeing today?
Yeah, I mean, it would be like... And so the dynamic then would be the idea that because we're seeing such dramatic drawdown of U.S. inventories, that places more urgency on the White House to find some way to stimulate more supply. So maybe the meeting wouldn't... I mean, the way that I can make sense of that in market terms is, let's say we had, inline data exactly as predicted. Maybe the market would be right where it is right now, but the reason that a much bigger draw than expected, and we're still here, might mean that, as the White House has more ammo to say we're seeing a supply problem in the oil market, and to then use that as an excuse. And Russia, we know, wants to increase output. So, I mean, yeah, I guess that could be part of it.
Is that all you had, Kevin?
No, I was just curious as your take on that, just because, I mean, that's kind of one of the things that I was looking at. So I was wondering if you thought of that was having any impact. So definitely thanks for the answer there.
Got it, Gav.
All right, so now let's address the equity markets. It was interesting because I know last night after the initial headline broke, you thought it might have been a buying opportunity, and the tape isn't necessarily suggesting such a thing. So now that you've had some time to process that, what are your newest thoughts on the equity market?
Well, I mean, we're back above where I said that, aren't we? So, I mean, I'm not saying that is, hey, I want.
Oh, I didn't know exactly where that was, but still being down.
Well, it was after I mean, that was, I think we were around 27.75 or so. But, again, look, that was more the statement of, this is not surprising. And I don't think that it is surprising. I don't think there's any way you can paint this as a surprising move. They told us they were going to do this, and even if you look in terms of the world of, whether or not everything is a bluff and a threat, this had to happen. We had to get to here. We had to get to 200 billion. We had to get to something that would be greater than a level that China could do as a tit for tat. That was written into the equation from the very first start of this. Either we got a negotiating table situation, or we got implemented tariffs. Once we chose choice B there, we have implemented tariffs, then there's no way of not getting implemented tariffs where the U.S. is able to, exploit the fact that it has a trade deficit with China by implementing tariffs on more goods than China imports from the U.S. That had to happen. So here we are. And again, the White House said just a few weeks ago that this is what they were going to do. And maybe this is about a week ahead of schedule, but I can't understand how this is seen as a surprise.
Well, that was my argument. This is nothing much more than a double dog dare, and
yes.
Here we are, down 16. We haven't really had a ton of buying. I did highlight a little earlier that the mode has changed just from the open just a little bit based on what we saw overnight, but really not enough conviction. And I know you haven't stepped out to enter a long trade. What would be the thing that would trigger such to get you inclined to maybe dabble getting long this?
I think I need to see what the retaliation is. I mean, I want that news out. As soon as we get that, probably you have to know what it is they're gonna be specific, and they say that they're shocked, but I cannot imagine that. I mean, that is this is political theater on a world stage right now. Everybody is acting their part perfectly. There's nothing surprising here to anybody who's actually on the stage and playing, and. We just need to see what it is. They've been thinking about it. China's been thinking about what to do. They knew that at some point the U.S. would announce a tariff level that they couldn't match tit for tat. I think this was there's no way that any planning in Beijing has ever been premised on anything other than this exact problem. Right? There's no chance of that. This is not, what are we going to do now? We didn't see this coming. This is what they've been. Why every meeting that's happened in Beijing for the last couple of months has happened is to answer to this move. And, there's probably a debate going on there about exactly how to implement it. And I would say, at this point, speculations we've seen are probably, they probably don't want to be too inventive because it doesn't look good, right? I mean, there's you're not supposed to do tariffs, but you're really not supposed to do things like, intentionally delaying goods from another country at the border to do deeper inspections and stuff like that's on the real big no-no list in terms of the World Trade Organization. And if they're trying to use that as one of their vehicles to retaliate is to launch, official challenges at the WTO, then they can't really take the law into their own hands, so to speak. But they're going to have to do something. So the question is, they must have. There are certainly ways that the United States can leverage, or that China can leverage its relationship with the United States and with corporate America specifically, so that they can inflict economic pain that scales to roughly an equivalent measure to what the U.S. is doing. There's ways to do that, and the question is, how did they formulate it so that it targets what's important to the White House? And then you got to look at what's important to the White House. And I would say, if it were, if they're smart about this, they're going to find a way to do things that they want none of this to happen, but they want the way for it to not happen to be about forcing a negotiation because they show that they can do things to the outlook for the White House that are just as bad as what the White House can do for the outlook to Beijing. This isn't about China and the U.S. This is about the White House and Beijing. And the way that those decisions are made, I would imagine that the target, if they can figure out a way to do it, would probably be to do something that really, really infuriates basically center-right Republicans. I think that that's kind of the key swing vote coming into midterms, and that's probably what this is going to boil down to. So I would imagine you're talking about the corporate class, the investor class, et cetera. You're talking about U.S. asset prices. You're talking about availability of supply chain logistics in the way that has been established for the last 25 years. I don't know whether you're going to get, I mean, certainly you throw in renminbi devaluation from here. I would imagine that's got to be part of that, because you balance what the U.S. is doing by just devaluing your currency to some extent, and you can basically get that 10% back on those 200 billion of goods. And there's that causes its own set of problems, but it does for the whole world. It's basically like, inventing more deflation. So, I don't know what it's going to be, but I want to find that out first. I think once that, because we're kind of sitting at this point where, we're after one punch and we need the counter punch. And once you get the counter punch, then I think that probably, as long as it's not something that's dramatically outside of expectations, then I think that's probably, this has all been expected. The market has been considering this. I don't see how this is a game changer. Maybe the market just has been getting away from reality in some way. I don't know. But we're going to have a quarter coming up here where, as Gavin pointed out to me the other day, we're going to see 23 to 25% earnings growth. And that, everything that we're talking about here with China is kind of like, it's an abstract idea about an abstract future that may or may not come into existence, and that has to do with earnings, 2 to 3 quarters from now, on some level. You put guidance ahead of that. And so the question is, do we get a response from China that suggests that if all this gets implemented, we're going to get 23, 24% earnings growth on the S&P, but maybe we're also going to hear a lot of really bad conference calls. And so that really, I think, you're going to get into that balance point when you're talking about equities. Are we going to get enough information out in the next few days so that we're going to get good earnings growth followed up by management teams that are just sitting there saying, I don't know what we're going to do, the rest of the year is going to be crap, and that really would hit the market. So I think I just want to see where that story goes. We don't have a lot of sentiment imbalance one way or the other, so it really just comes down to kind of chasing down that narrative. Again, we've had last 6 weeks have been great trading-wise, I think. We got the VIX up to 20. We got some good back-and-forth two-way trading in equities. We had some nice action in currencies and commodities. And we've had a lot of interesting opportunities and a lot of good trades. And it may just be that there's a lot of crosswinds right now. And, we're back in a headline minefield, and you want to be a little bit lighter on the gas pedal.
All right. I think that's a pretty fair assessment. Man, you were talking about the VIX getting close to 20. I don't even think it cracked 20, did it?
No, but I mean, in this day and age, I'll take it at 19.
I know, but you only got
it offered up a bunch of good trades. We had some nice back and forth, and it would be great to see. Hey, I would like to sit at 22 for the rest of the year.
I'd like to see it 22 for the rest of my life. That would be. I mean, that's the heyday, right?
Yeah.
All right. So I want to ask you a question from a listener. I think I probably know your answer to this, but he doesn't.
Okay.
So the listener question asks if you have thoughts on other commodity markets such as coffee, sugar, soybeans, platinum.
And I would be curious to know what you think my answer is going to be.
Well, I think your answer would be you always have a thought on it, but to give you any type of detail, you would probably need some time to look at it and come up with your own analysis before you can just rattle off something on the top of your head.
You're exactly right, Jim.
See? Well, now, you know what? So when you're not here, so every day we can do a chart trader interview. I'll just pretend I'm you. And then when I stump myself, I'm like, the kid's got to eat. I got 3 kids to feed right now, so wife's calling.
Hey, there you go. Then you step off that train, maybe. But yeah, exactly right. I I can, I mean, soybeans, I guess I would have just the thoughts that, wow, what a headline hit market. That would be, they've been the main thing that China's known that they can go after for the U.S. And beyond that, there's not a lot of thoughts. I mean, precious metals, we got platinum in there. I see the feedback. We've got platinum in there. Precious metals have been, you're talking about a potentially new leg that's gradually evolving for the dollar bull market, which is pretty tough times for something like metals like that. And at the same time, as I said, this whole process, the one thing that you can, and China really plays into, at least two of these pretty easily for me. China, as I said, one thing you can guarantee from this is devaluation of the renminbi, and through mechanisms that will be too complicated to really explain, that is a force that exports deflation. And if you match that with a strong dollar, that's a tough situation for metals. And I think it's, we've been seeing it we took advantage of basically, what we saw in the divergence trade reemerging to short gold, but you've seen gold just have a tough time getting off those lows. It's sitting under 1250. Silver broke down under 16. Platinum's going to be in, a pretty similar situation right now. This isn't a context that's going to make it, really favorable. Copper has really just started to get mauled lately, but, that's even more really intrinsically tied into performance of the Chinese economy and not as much toward currency deflation and a strong dollar market. But that, obviously I wouldn't, in a standard approach, I wouldn't think long platinum in this kind of context is one of the types of plays that I'm looking for. Soybeans are interesting just because, we've seen such a headline driver there, and anything that, is driven by headlines in that particular way, can obviously be driven exactly in the opposite direction by the opposite type of headlines. So, it's vulnerable to something. I would imagine sentiment on soybeans has got to be about the lowest that it's been, maybe. I can't imagine a context where more people would be more obviously bearish on soybeans. So
what is the
that presents the possibility of a really sharp turnaround if the context appears to be changing.
Did you look at the COT on that one, the commitment of traders data on soybeans?
I peeked at a little bit. It's net short among speculators, but it's, which is a relatively rare situation. It's not maybe as net short as I would have thought, but that is in the balance. We know that there is an issue that is political in terms of how people are positioning in that market, which means whatever the current trader positioning is, it will shift dramatically if that issue heals itself. Let's say China comes back with a round of retaliations that really makes the White House believe that this is going to be politically detrimental to carry this too much further, and they go to the negotiating table. They get something that the White House believes that it can sell as it approaches midterms as a win. And China gets something that they believe is not dramatic enough that it's going to really embed aggressive nationalist protectionism in the U.S. political system for years to come, which I think is the main goal here for China. Let's say that happens, you're going to see soybeans rip higher. I mean, I don't think there's any way that that's not going to be a part of that equation, because we know that whatever it is now, there's a finger on the scale that has to do with the potential for massive tariffs from China on soybeans.
The other thing that I would have mentioned as far as your thoughts on things like outside of soybeans, so coffee, sugar, and platinum, these markets don't trade very well, so they're really tough to get good trades on. Soybeans is one, but again, they have a different type of market where it's not really 24/7 trading hours. They have these big breaks in between, right?
Yeah, right. So I mean, when you're talking about the softer side of commodities, now I traded platinum. Platinum's not too bad.
Yeah,
it's a little thin.
Right.
It's a little sparky, but it's like trading silver, except maybe one notch up. But
the tick size isn't as big in platinum, is it?
It's not as big, but it's a little thinner of a market. Okay. So if you're trading a little bigger size, and the volatility in general is pretty extraordinary. Okay. So if it were thicker, it'd probably be a bit more interesting to me. But it's something where you may, if you transport your size from other markets into that, you can't carry it across without really feeling a little nausea at times. So I guess I associate it with silver that way. Otherwise, yeah, I'm not somebody who does a tremendous amount of trading in terms of softs or grains.
All right. The one that is interesting, I'm not even sure how the dynamic works. I think the CBOT trades the rice contract, the rough rice.
I think that's right.
And that's moved in complete opposite direction as soybeans. So it's almost as if you would have had a crystal ball, short soybeans, long rice, and that would have been a great trade. Is it because we import rice? Are we net import?
Yeah, I mean, I would say rice is probably China's biggest cash crop. So,
right.
I mean, it's.
Do we even grow rice in the U.S.? I don't think we do we?
We do. We grow it, as I understand. There's a tremendous inefficiency that I learned some years ago, where the areas where we grow the most rice happen to just be in arid areas, and so we have to import massive amounts of water to do it. Which is, we could just grow it where there's lots of water, and we don't. I mean, imagine growing rice in the Everglades; it'd be spectacular. Where you can get permits to farm. It just, for some reason, we tend to grow it somewhere in like Arizona or New Mexico. I can't remember, and it doesn't make any sense to me because obviously you need wetlands to grow rice. But so I'm not sure. I know it's not a big crop for us though. I mean, compared to obviously China, that's going to be it's synonymous with Chinese agriculture. So
all right. Let's see. Are there any other markets that you have that have piqued your interest as of late?
I've been kind of focused on the usual suspects. Obviously, we've talked about possibilities of shorting the euro and betting on the dollar to move higher. That's in a continued sideways range at this point, acting on a number of relatively bullish catalysts for the euro over the last few weeks, not really rallying too much, which tends to confirm my basic sense of trend there. But, the commitment of traders data has gotten pretty even-handed on that. I think there's, at last count, I think we had 36,000 net long large spec. So that's really not exactly, that's almost a balanced market, which makes it, kind of tough to pressure too much, even though I think that should be a net short market and that we may still see that transition. If we see that transition before we break through that low, it will be tough for me to continue forward with the idea that I'm going to be aggressive at any point about that trade. So it's just a matter of kind of, watching it, letting it ripen, and seeing if it, looks like something that becomes more ripe as an opportunity based on what I'm looking at. Obviously, I've been watching crude pretty closely, but now today's action and all of these different dynamics, I need to figure out where I stand on that. So, and I'm waiting for the retaliation from China as far as how I approach equities. So that's pretty much where I am.
I know one that I was going to ask you about, and that's the yen. We didn't exactly see the type of response that you would normally see when you get that reaction, especially when it comes out. When you get an off-hour headline that's macro-related, and you see them selling off the indices, you would typically just automatically, it's almost like an algorithm that just kicks in, sell off the S&P, buy the yen. You did not see that last night.
You did not.
So,
exactly right.
Did you have a take on that?
Oh, that's bearish for the yen. I think unquestionably. I mean, when I've seen it, it's a funding currency. Funding's out there.
That would mean your Nikkei trade might be in play, right?
It suggests advantage Nikkei on a post-China retaliation firming up of risk assets, yeah.
All right, so there you go. A little more ammo in that, when you get ready to pull the trigger on there. So,
right, I would say test at 23,000 should be a given that pattern. The question is, do we get to 24,000 again? I'm not sure, but I would think breaking back up into that 23,000 area should be a target.
Well, good to know. Part of what I try to do is give the listeners a little bit of a cliffhanger so that they're ready for your action. Sometimes you get disappointed and you don't get the action, but you gotta set it up. You gotta set up the give them some bait, right? So that they know, hey, I gotta get ready for this Nikkei. I gotta type it into my the your watch list or your order book, whatever it is that you used to order to put a trade in the queue. You got to get that ready. So always got to get the listeners prepared for that. So I would think that that's probably on the top of the list of things that may be of your next good trade idea.
Yeah, I think so too.
So, and we've talked about it. We started last week. I know you had some listener questions asking what are the ETFs that you can use and whatnot. DXJ is the one of choice, I believe, right?
Yes,
All
absolutely.
right. All right. Well, I think we have given the listeners enough to chew on for a bit, and unless you have anything else, we'll reconvene most likely next week, unless we have something big, some type of big headline that we need to digest. I'm actually out until, well, I'll be in tomorrow, but Friday and Monday I am out, so we won't be able to catch up until Tuesday if we don't talk tomorrow.
Gotcha. Sounds good, Jim.
All right. Well, thank you so much, Brett, as always.
Okay.
All
Take
right.
care.
You too.